Bloomberg Audio Studios.
Podcasts, radio, news.
This is Bloomberg Businessweek. Insight from the reporters and editors who bring you America's most trusted business magazine, plus global business, finance, and tech news. The Bloomberg Businessweek podcast with Carol Massar and Tim Stenovec from Bloomberg Radio.
Okay, so lots happening today, too, when it comes to the micro. Some deal news. Verizon agreeing to buy rival telecom operator Frontier Communications parent for about $9.59 billion as Verizon looks to expand its high-speed internet business. Here's Verizon CEO Hans Vestberg earlier today speaking on Bloomberg TV.
This is very straight into our core strategy. We are sort of in mobility and broadband, serve basically all types of customers in this market, consumer, SMBs, large enterprise and governments. This is just extending the offerings and optionality for the customers we have. So this is a really good decision by us to do it.
For more on the implications of the deal and why and how it came together, we turn to Chris Palmeri, Bloomberg News Entertainment editor, as well as Michelle Davis, Bloomberg News senior M&A reporter. Michelle here in the studio with us. Chris is out there in Los Angeles. Chris, we just heard in that clip from Hans Vestberg that this is part of the company's core strategy. Is the bet here that we're just going to keep using more and more data as a result of the explosive growth of AI, the excitement around AI? Is that what this is about?
Absolutely, that and working from home, which I happen to be now, and on a fiber network from AT&T. So so that's part of it. Just and video, of course, the streaming evolution of TV, and all of that is massive data feeds to the home at higher speeds, and that's what fiber does.
Michelle, tell us a little bit about how this deal came together, the history of both Verizon and Frontier in the telecom space, and did Verizon get a good deal?
Yeah, so we're in a bit of a new era right now where all the cellular providers, AT&T, Verizon, T-Mobile, they, as Chris was saying, are trying to get into the high-speed internet game. And the last time we saw this big shift was when they were moving from landline to cellular. And so right now, the idea is, let's bundle cellular, let's bundle high-speed internet and try to compete with the cable companies. In terms of the history, Frontier's claim to fame is their broadband access. Verizon has been, the top wireless provider that we all know. But they hadn't really had a big presence in fiber. With this deal, if it closes, they will be vaulted to the top ahead of AT&T, who is right now the number one fiber offerer among the wireless providers. But, even they hardly compete with the cable companies in terms of high-speed internet access.
Michelle, when we think about the history of this space, this is a history that has been just dominated by M&A. That's how, and actually, breaking up of large companies over the last century. If we think about telecom, regulatory hurdles for Verizon here, is that something that regulatory risk, is that something investors have to be worried about?
So if you look at Frontier's stock today, it is trading down and below the offer price. Some of that, some of the decline is because yesterday people didn't know what Verizon was going to pay. So that's, they got ahead of themselves. And a little bit of that decline has to do with this, concern about regulatory scrutiny. No one that I've talked to thinks that they're going to have any issues, but in this environment, regulators have just been taking a harder look at things. They're taking longer to review things. Obviously, if there's a change in administration, which there probably will be, and we just don't know how it will go, that could change how long, regulators take to review things.
Chris, I'm wondering how many details we have about where Verizon is going to actually deploy this high-speed internet, because we know that millions of Americans actually don't have access to high-speed broadband. Is this something where Verizon is kind of serving those underserved regions, or are they competing with the incumbent cable providers in areas that already have internet?
A little of both, but definitely they're looking at rural areas. AT&T is as well. There's a lot of fiber build out in places that historically didn't get it, and that's part of this. I think Verizon said they'll be in 35 states with this acquisition. So yes, a very broad offering geographically.
Chris, what does this mean for customers of Frontier? They have a couple million broadband customers already. Do they just automatically become Fios customers?
Yeah, that's certainly the plan. The CEO said he didn't expect, this to result in like any kind of price war or something like that with anybody else. But that always seems to be the case in telecom. I mean, this in a way is a reflection of the challenges these companies have had with mobile being sort of everybody has a phone or two at this point, and where else can you grow? And so they're returning really to this business that they had offered back in the dial-up internet days.
Well, Chris, to that point, I thought that the future was all about wireless, even when it came to broadband delivery, because it is very expensive to lay fiber. And these companies are working on delivering broadband wirelessly to the home with these receivers that people set up on their own. They don't even have to call people out there to come and hook stuff up to the telephone wires. What's going on with that strategy right now?
That I think this deal is really a recognition that that's only part of the solution, that if you really want to get the super high speeds, you need this fiber optic line, even in some cases directly to the home if possible. And that the wireless, well, as you said, people are investing in and they're showing some good growth in that way of accessing. It's probably not going to be the single, main way people access.
Yeah, Michelle, come on in on that, because the capex when it comes to laying fiber is incredibly expensive, and also you got to get the neighborhoods on board.
Yeah, so I mean, Verizon has a lot of work ahead of it in making this a real thing. But if you think about fiber, FiOS, I don't know if you guys have used FiOS.
I have FiOS, yeah.
It is just lightning speed. It's faster, way more reliable than what you can get with wireless. So it's clear that it's not quite interchangeable, but it is going to take them time to get to a place where this is the default.
I was going to ask a similar question, but maybe what is the kind of history, what do we know already about companies that have merged in the telecom space? Have they been able to kind of successfully compete against those cable companies that you had mentioned earlier when, they acquire these fiber companies?
So T-Mobile has been doing a bunch of joint venture deals to try to broaden its fiber broadband access. They recently did a deal with KKR where they agreed to both invest in Metronet. And AT&T, has been the leader in this space. But the whole industry, I mean, when you think about telecom, cable, media, as we earlier were talking about, it was built on M&A, using debt. A lot of these companies have gone bankrupt and come back around again, including Frontier.
Yeah, that was a relatively recent bankruptcy.
Relatively recently, but they find ways to reinvent themselves and get more debt and buy and separate, and here we are.
Chris, there's also a media story when it comes to this, because Verizon is also with FiOS. They do offer traditional over the top cable box service, I guess is what we'd call it. We wouldn't really call it over the top, but they do offer cable box service, traditional linear TV. How do you think about that in the context of where they're doing M&A right now?
It's part of the thing, and one of the things Verizon's been active at is including other streaming services as part of their broadband business. As everyone knows, the traditional cable bundle is collapsing, and so this is really the next evolution of delivery of TV. And Hans Vestberg said in our Bloomberg TV interview that having this multiple product offering to consumers helps reduce the churn. They're less likely to cancel if they have a Verizon mobile phone, internet offering, TV.
Michelle, what's next? What are you watching for in terms of timeline?
The big question is AT&T or T-Mobile, are they going to do something to get back ahead after this?
Chris Palmeri, we're lucky to have both of you today, and you're both writing a lot of stories, but I want to shift gears a little bit and talk about a story that you published just about an hour ago about the future of what happens with National Amusements and Paramount. The name Ellison is at the top of the story, but it's not David Allison, it's actually Larry Ellison. Explain what exactly is going on here.
Well, this was always positioned, this takeover of Paramount, as David Allison, Larry's son, but everyone always assumed that the money was coming from Dad. He's the founder of Oracle Corp, of course, and worth over $150 billion. But we hadn't quite seen it in writing, and in this situation where you have to tell the regulators, in this case the Federal Communications Commission, who's going to own these, that CBS TV network and all those local stations, and their filing says, well, it's actually going to be Larry Ellison who controls it all.
So what does that mean for the company, but also for what David's going to do at the company and who's actually going to be the one making the decisions here?
Well, David, as the filing said, will be chairman and CEO of Paramount, and his spokespeople have said he will have operational control. But you don't have to look far in the media landscape to find incidences where fathers have fired their sons. If you think about the Murdochs and all the changes they had over their media empire, the Dolan family as well in cable TV had some dust-ups. Even when the Redstones, there was a period of time when Shari Redstone was out with her father and that. So I don't want to presume anything, everything may work out fine between the Ellisons, but as long as Larry is the controlling person, there is always that option.
Yeah, maybe no offshoot of succession at this point yet. Chris, is the deal happening? Is this thing finally going to be put to bed?
Yeah, they've got a signed deal. At this point, Paramount really can't consider other offers. There's still issues regarding like this one, regulatory and that, but it certainly seems like it's going to close next year.
Okay, certainly around the world when it comes to telecom and media, with Chris Palmeri out there in Los Angeles. He's Bloomberg News entertainment editor. Also, Michelle Davis, Bloomberg News senior M&A reporter. Michelle joining us here in the studio. Chris joining us from Los Angeles. A big thank you to both of you. Check out all of their reporting on the Bloomberg terminal and, of course, at Bloomberg.com.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
As we've been discussing, Wall Street's anxiety running rampant in that countdown to the highly anticipated U.S. jobs report. It's not just the jobs report that has people wondering about what risks do lie ahead. There's geopolitics, there's uncertainty ahead of the election, and for some people, how tech could continue to affect the economy, really big picture stuff and fundamental stuff. Dave Allison works with ultra high net worth clients at the RIA platform Prosperity Capital Advisors, where he's president and founding partner. They've got about $3.5 billion in assets under management. Dave joins us here in the studio. Dave, good to have you with us. Welcome to Bloomberg Businessweek. Give us an idea of your typical client, how much money they have how much money they have deployed with you, and sort of give us the profile.
Yeah, definitely. So we work with clients all over the United States. Typical client is somebody that is, 55 to 65, approaching retirement, maybe $1 million to $10 million, and that's at the firm level. I typically spend my time with the families that have $10 million to, maybe $50, $60, $70 million and helping them implement their family wealth strategy.
So let's talk a little bit about those families and asset allocation there, because traditionally we've heard a lot about, at that level, allocating assets to the private markets, but not necessarily in recent years as much discussion of that as there has been in the past. What do you see as sort of the asset allocation breakdown for the ultra high net worth family that's trying to have generational wealth here?
Yeah, I think the asset allocation breakdown is still, pretty heavy in the public markets. I mean, obviously, you can find outsized returns in the private equity space or private market space. Yeah, on occasion. I think there's a lot of hype and buzz coming back post 2021. I think there was this great reset that happened, and now, there's a lot of still speculation around AI companies and some of the derivatives that'll come from this technology and who's trying to build the next services and platform that'll be supported by AI. So I think we're seeing, a renewed interest in that space. But, the reality of it is public markets are still delivering great returns and there's still huge opportunities. And so, it might be not as much hype as we saw maybe in 2020 or 2021.
When you talk to your clients, how are they currently feeling about both the U.S. economy and also the stock market?
Yeah, well, I think people are still fairly optimistic, although, as you just mentioned in your opening, a lot of uncertainty. And I don't know if that uncertainty is as much the economy or the stock market as it is everything else going on in the world. Political, geopolitical, wars. I think that drives a lot of the uncertainty, which unfortunately starts to transition over to people's money in their portfolio. But, as much uncertainty exists in politics right now and in geopolitical events, I think there's still this big wave of optimism of, what's going to happen with some of these companies that do have enormous upside from a productivity, from the technological innovations that we're starting to see happen. So,
what are some examples of those companies or of those services?
Well, I mean, of course, there's the big ones that we all know about, right? The big ones that have been number one benefactors of the hype around AI and what it could do to their own internal productivity. There's been the benefactors like NVIDIA that, of course, everyone knows about, of the spend from these hyperscalers. But I think what's interesting is to start to look at kind of the next derivatives of who's going to get beneficial productivity growth or revenue through monetization of services. And I think we're still in like the first inning of what that even looks like. So, there's of course, companies in different areas, the big ones that we know about and hear about all day long. But, I still think even in the small business side, small company stocks are still trying to figure out how to harness or utilize some of the AI tools.
So how would that end up looking for these other companies? Is the idea here that the companies become more efficient and don't need as many employees, and perhaps we see an uptick in unemployment as a result? Or do we see something else entirely where the companies become more productive, but those people are still needed?
Well, I'm certainly hoping for the latter, right? I mean, as an employer, we're a small business. We have about 75 employees.
Do you use AI?
We are just starting initiatives. Obviously in the wealth management industry, we have a lot more compliance and regulatory concerns around how we use it, but we're trying to empower our employees to use it. And we're not doing it as a measure of cutting back. We're using it as a measure of how can we grow, how can we impact more clients, how can we be more efficient with our advisors. And so, I hope that most other industries are looking at it more as a tool of an abundance than scarcity. And so I think that's a great reason to be optimistic. I mean, will jobs change? Of course, jobs will change. That happens in every major technological advancement or shift. But I think, companies are going to continue to see ways to grow productivity and hopefully drive earnings and more efficiency.
What does that mean for the breadth in the market and the broadening out of the rally? I was looking at a chart. The equal weighted index, S&P equal weight, has outperformed the market cap weighted index over almost 6 percentage points since July. Do you see that continuing?
Yeah, I hope so. I mean, you wonder, is that somewhat of cause or effect? I mean, the reality of it is what we saw through the first half of this year was the big names, the hyperscalers getting so much attention and so much money thrown at them that the reality of it is kind of all good things have to come to an end at some point. And now we're to the point with those biggest companies, it's like, hey, you're spending all this money, start showing me some of the impact. And we're also seeing a lot of people, quite frankly, just take gains off of those bigger company names. And where's that money going to go? It's going to go to the rest of the market. I think, we're still kind of early on to see how it's going to spread out, where it's going to be dispersed, what industries are going to be able to adapt and use these tools for productivity. But, I do anticipate that while we're still going to see these kind of big name hyperscalers spend a lot of money, gain a lot of momentum, gain a lot of interest, I think you're going to start to see the rest of the market, not just the S&P 500, like you mentioned, the equal weight index, but, even hopefully looking at other asset classes like small cap, start to benefit from some of these tools, particularly if we start to get into a rate lowering environment where they can start borrowing money to generate their own CapEx spend at a small cap level.
Let's talk about bonds
Sure.
as well. What is the allocation to bonds? Because for the last few years, investors really haven't gotten that much of a positive return if they're in bonds. Do you see that evolving? Have you had to change the kind of typical stock bond portfolio composition with your clients?
Well, what's interesting about bonds is it really depends on the type of investor, right? If you're a younger investor in the accumulation phase, you're not really needing income from your portfolio, and you're, of course, focused on trying to generate the highest expected returns, bonds probably aren't a big part of your asset allocation. I mean, bonds are the seatbelt in a car. They're there for safety. They're there to generate income. Obviously, for our retiree clients, generating consistent cash flow and income is certainly a lot better today than it was 2 or 3 years ago. There's a speculative element of bonds, right? As interest rates fall, the principal value of bonds go up. But I still think people are more bullish on the expected return of equities over bonds. We are still sitting at, of course, for most of our growth-oriented clients, a higher equity allocation than fixed income. And again, fixed income is a great place for that short-term money or when we're trying to generate cash flow. But, I don't see a whole lot of speculation happening on capital returns of fixed income.
Just in the last minute that we have, November election, front and center, certainly in terms of how we're thinking about coverage up till then. How is it on your radar?
Yeah, well, I mean, the reality of it is we all know the market hates uncertainty, and there's an enormous amount of uncertainty. And what we've been telling every one of our clients, things are going to get bumpy. Things are going to get bumpy in September. Things are going to get bumpy in October. We've seen this in almost every election year for as long as we have data. September and October are not typically great months for the market. And so it goes to, are you trying to time the market or are you a long-term investor? Because as soon as the election results come in, we tend to see a trendward upwards for overall markets. And so, if you're trying to trade and get ahead in market time, hey, there's probably some opportunities with all the volatility we're going to see. But if you're a long-term investor, stick to the course, have a good portfolio, look at what your bets are in these allocations that you have, if there's opportunity to rebalance or reallocate, and don't pay much focus to the day-to-day that's happening.
Dave Allison at Prosperity Capital Advisors. Thanks so much for joining us here on Bloomberg Business Week.
You're listening to the Bloomberg Business Week podcast. Listen live each weekday starting at 2 p.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
When we talk polarization, especially these days, it's often in the context of politics. But there's more to polarization than just political polarization. That includes economic polarization, which is, as you guessed it, people on opposite ends of the economic spectrum. And according to our next guest, economic polarization now showing up in the workplace, and it has real implications when it comes to productivity. Richard Edelman is CEO at the global communications firm Edelman. He joins us from New York. Richard, we check in with you periodically thanks to the updates that you and the team over at Edelman do to the Edelman Trust Barometer. It's a global survey. It looks to understand why people think the way they do. What did you find about economic polarization, especially in the workplace?
So what we found is that, in fact, the so-called associates, the working class people, have a much lower opinion of institutions than the executive class, and that gap has just widened over the last 5 years profoundly. And so now there's a 40-point gap between, again, what the worker thinks and what the executives think about trust in business, government, media, and NGOs. And that is to do with the experience of globalization, the experience of COVID, and then the experience of inflation. And so even though their wages have gone up, people are terribly nervous also about the fear of AI.
Does it also have to do with compensation, though, and the different way that people are paid for their work when they're, I don't want to say at the entry or managerial level, but no question that C-suite pay has absolutely exploded over the last couple of decades. I mean, we have it available on the Bloomberg terminal. You can go look it up for publicly listed companies. It's just mind-boggling how much these executives are paid, I think, to a lot of people. They would say that it's, that's the market rate and that's what, they're bringing that value. But does that distinction at all have any effect on how people think about economic polarization?
It's certainly to do with pay, but it's also to do with the projection of economic future. And when you look at the 45 to 65-year-olds, only 19% of our respondents said that they believe that their families are going to be better off in 5 years. Whereas the younger, 65%, the 18 to 35-year-olds, they believe in the future. And so, again, the 45-year-olds have seen globalization. They have a huge fear of being, in a sense, exiled from work by AI. So upskilling becomes a urgent matter for business so that people are calm about their future. And if there's going to have to be change in your size of workforce, just tell them the truth and don't let it creep up on you.
How did the survey define and measure economic optimism? Can you perhaps maybe share some of the questions that were asked of the survey participants?
So it's a very simple question, which is, do you feel your family is going to be better off in 5 years? And we see a consistent diminution of expectations in the people in the lower economic echelons, and particularly, again, the people who are 45 years old plus. And it's partly the experience that they've had with globalization, which their younger group hasn't, and the projection of AI, which everyone is nervous about, but the younger feel somehow better equipped to do it.
And what did you guys find about just why economic optimism for those employees is so important? I see in the notes it drives employees to be more civically minded.
Well, from a practical point of view, if you're a business owner, it's more employee loyalty, more employee advocacy, and they're much more willing to engage in transformation of the business. So, for example, if you're optimistic about your economic future, you're much more willing to accept AI. But it shifts completely to the opposite if you're nervous about your economic future. So all of this is circular. And the virtuous circle that we need to do is calm people down about their future, pay them well enough, then they'll be your advocates and loyal to your business. And they'll also, by 2 to 1, put in the extra effort that, makes sure that the company will succeed.
What does it mean to pay someone enough? How do you know what enough is?
I think enough is that people feel as if they are staying ahead of inflation, that they have the chance for a better life, for a house, for a retirement, because at the present, all of those are in question. And, this, of course, then becomes political in the end of, which party has a better idea for the future.
Besides just pay, how else are you seeing companies react to this low level of employee economic optimism?
So I think CEOs have thought in the last 3 or 4 years that one of the great plays is to be public advocates on sustainability, diversity, inclusion, geopolitics even. That's reversing. And there's a sort of rebalancing of stakeholders. So Wall Street and customers and regulators matter equally to employees. So CEOs are well advised to continue to speak to their own workforces about these societal issues, but not to become public advocates. Also, companies are responding by what is termed as agency, giving people within the company the chance to feel as if they're making an impact, to give them a voice, to listen to them, to have town halls and other ways of expressing your desire to learn and listen.
Richard, before we let you go, we just have about a minute left, but you're CEO at Edelman.
Yep.
Are you using AI right now? How are you using AI if you are?
So personally, I write my blog post every week. My ChatGPT is my English teacher in criticizing my ideas and my grammar, which is very helpful. I also ask the ChatGPT to help me on formulating my company strategy document that I just have to prepare for my board for next week. And I am pushing myself to use it. And I'm also asking my younger employees, how are you using it? We're putting it on 5,000 desktops across Edelman in the next 3 weeks. And we know that we have to be efficient. We know also that we have to be smarter. And that's the key. We don't want to take jobs away. We want to make our work better so that we can get premium pricing for our work.
Hey, it's an interesting way to think about it. Richard Edelman, CEO at the global communications firm Edelman, joining us this afternoon from New York.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
I can't talk about it enough, Emily. We are all focused on that jobs report tomorrow, 8:30 Wall Street time, because Fed Chair Jay Powell has put the labor market at the heart of the central bank's decision on when and how quickly to ease. So how are things going to look tomorrow? Well, if you go to EcoGo on the Bloomberg terminal, you can see that economists surveyed by Bloomberg are expecting 165,000 jobs for the month of August. So we'll see if it comes in at that level, higher or lower than the level. And of course, there's going to be a close eye on revisions.
And the unemployment rate, which they're expecting 4.2%. That would be a drop from the 4.3% prior. But as Mike McKee told us, watch the rounding.
Yes,
because
he's all about the 3 decimal places, right?
They report in a 3 decimal place. So traders might not see that. They might only see the 4.2.
I'm curious what Martha Heller is seeing. She's founder and CEO at Heller Search. It's an executive search firm. It specializes in IT leadership roles. She joins us from Massachusetts. Martha, good to have you back with us. Remind everybody the subsegment of the workforce that you're looking at, because you're not seeing the entire workforce, given that you specialize in IT leadership roles. But remind everyone what you're seeing.
Sure thing. So what we look at is the technology workforce across all industries. So yes, high tech, but we're also looking at retail and insurance and manufacturing. So it's every industry, but that particular technology workforce. So for us, we're of course very interested to see what the numbers tomorrow hold, because they're either a bellwether for growth or they're going to indicate a shrinking of workforce market, which of course we're not excited about. But to me, and what I'm seeing, Tim and Emily, is something bigger than whatever the jobs report shows tomorrow. And that is really in how much AI investments are driving job growth in the next 12 to 18 months. If we're talking about a $600 billion overall investment in AI, which is some of the numbers we're hearing, people need to give a return on that investment. You need engineers and integrators and developers and analysts and data scientists. And keep in mind, every time we open an AI opportunity on our big businesses, we open a security risk. And the fact is, experienced AI security engineer is an oxymoron. It doesn't exist yet. So regardless of what tomorrow's numbers show, I believe overall, from Silicon Valley to middle America, manufacturing, retail, we're going to see an overall uptick in hiring in tech due to the need for people to make that AI dream come true. We'll see how that all happens, but I think in the next 12 to 18 months, we're going to see an uptick in technology hiring across the board.
And what trends are you seeing right now? Because would this be an uptick from, a downturn in hiring? Just talk about maybe the last few years, this demand for more jobs in IT. Has it been steadily growing, or did we see a peak just a few years ago and now we're kind of working back up to that?
We saw a peak during and immediately after COVID, because we needed all those technology people to get all those people working at home. Once we had that, we had a catalyst in terms of digital transformation. Maybe we wouldn't have all been so digital if COVID hadn't come along and sort of forced that on us more quickly. And as a result of that, we've seen tremendous hiring. We now need to fund our digital products as an insurance company. We now need to do more digital access for our people buying groceries. That was all sort of put on turbo based on a sudden health scare that got us into this space. So I see this starting from before COVID and increasing steadily. Yes, we've had a hiccup with this jobs report or that jobs report, but I think honestly, since COVID, we've had a very strong uptick in hiring in IT across these businesses.
When you talk to these IT professionals, where do they want to work? Because I understand that nearly every company and probably almost every industry needs these tech jobs and these IT-focused people, but they might be in unconventional places where maybe a person who works in tech isn't thinking, oh, I want to go do software engineering at a grocery store chain, for example.
It's a fantastic question. And the first thing I would say, and it's so sort of banal to talk about, but they want to be remote. They don't want to come into the office. So that's first thing in terms of where they want to be. I'll also say what they want is to work on complex technology problems. They want to learn the new skills. So they don't want to come upgrade a payroll system. They want to run AI on a payroll process. So indicating to these folks, wherever you find them, that technology is the forefront of what you're doing, and they're going to get to do exciting, meaningful work. That is the message to communicate. In terms of where to go, tools are getting easier. AI is making software engineering easier or simpler. So we don't need necessarily the MIT trained computer science PhD in our businesses. We need people who can learn design thinking. They can do good training. They have a passion for the mission of the business. So we can start to really expand where we get our technology people from, particularly when AI makes some of those software engineering jobs repetitive. And now we need people who can look at our businesses and say, I have an idea for where AI can help us. So that's really not any particular education at all, right? These are people who have passion, they understand processes, they want to create change. They're not necessarily all technologists.
Yeah, it's pretty incredible to see what can actually be done on some of these LLMs already.
That's
and
right.
I've played with them a little bit, but I don't even have the capability to do what some people are able to do on these, Emily. I saw on Twitter/X, somebody posted a video of asking an LLM to create an app for them that had these certain parameters, and the thing completely spit out code. It was amazing.
You have to know how to communicate with it.
You have to be a prompt. Is it a prompt engineer? Is that right, Martha?
That's right. It's a prompt engineer. And even more, when you bring up, Tim, that you played around with this, if you had to invest $100 million in it to produce $300 million in revenue, suddenly that chat GPT or whatever you're using, you might look at and say, how am I going to get the money?
Yeah, that sounds pretty good to me, actually. Do you have some ideas, Martha?
I have a lot of ideas, yes.
Okay. Hey, I'm curious about what you're seeing when it comes to compensation right now. We watch wages really closely. What are you seeing? What's typical compensation for somebody you place?
That's right. So, I mean, the folks we place typically are the technology leaders in these Fortune 500 businesses. So they've fully loaded packages with long-term and short-term. I'm seeing them obviously in the seven figures. And then it depends. Is it a Fortune 20 company that now you're going to have? I talked to a CTO of a major media conglomerate the other day, and he's making $8 million a year, right? The CIO of a small company is not. But what we're seeing overall is CIOs and CTOs are now becoming officers of their companies. They used to report to the COO, the CFO. Now they're reporting a click up to the CEO. So their compensations are changing. They're now in that EVP or C-level band. And as such, all of their people get a lift. So as technology becomes forefront to everything we're going to do and the way we're going to secure our data and all of that, that becomes so important that compensation is going up. Could I give you a range over? I'd say maybe 20% over the last couple of years.
Oh, wow.
But it's gonna vary from industry to industry, obviously.
That's, compensation and pay. To what extent are these professionals looking for additional benefits? I know you had mentioned that a lot of workers are looking to work from home and be fully remote.
That's right. So that's one thing. And I would say what they're looking for more than anything is meaning in their work. I could plug in this widget over and over again, but how is this widget helping people? How is it having an impact on shareholders? What's the meaning behind my work? I think COVID kind of threw everybody for a loop and said, wait a minute, I did everything I was supposed to do. And then this thing happened. And now my course has been thrown off. So how do I want to spend my time? I want to spend my time having an impact. So more than anything, yes, let them work at home, fine, give them a good culture, let them have mentorship, but they need to know the why of what they're doing. That to me is the focal point for attracting good people.
We don't have a ton of time left, but I'm wondering what you're seeing as the biggest risk to this industry right now. Are people fearing layoffs at all?
What the biggest fear that I'm starting to see bubbles of or percolation of is the bubble. How on earth are we going to get all this return on this AI investment? Because remember, it's cool to use ChatGPT, but when you have a $200 billion business and you have to get all your data integrated in a way that AI can even matter, that's a big lift. So what I think we're going to see is something akin to the .com bust of 2000, where in 2 years, all those AI startups, they're not going to, this, again, this is just a prediction. I think we're going to have a big AI bust. And then over the next 3 to 5 years, just as what happened with digital and e-commerce, companies are going to understand how to use it. We are going to get that return on that investment. And I think out 5 years, we're going to be living differently. I don't know about you folks, but I remember analog. I remember the telephone that I would pick up and dial. And now life is so different. I think life is going to be as different, but we need 5 years to drive adoption of these tools and get our companies in shape and get the profitability from them to make it worth the board's while. So, what's the risk? I think the risk right now is an AI bubble. Right behind that is board level security preparedness for AI. Those, I would say, are the two.
Okay, so big changes coming in the next 5 years. We'll be sure to check in with you quite a bit between now and then. Martha Heller, founder and CEO at Heller Search, the executive search firm that specializes in IT leadership roles, joining us from Massachusetts.
I'm driving in my car. I turn on the radio.
How about you let me drive?
Oh, no.
Who's gonna drive you home?
Honey, please, I'll do the driving.
Drive on.
Excuse me, I want to drive.
It's the question that drives us.
This is the Drive to the Close
That funky music will drive us till the dawn.
on Bloomberg Radio.
Well, TikTok, everyone. Less than 20 minutes to go to the close of trading on this Thursday afternoon, just ahead of that August payrolls report, which we'll get tomorrow, 8:30 a.m. Are you covering it live, Emily?
No,
you're
not anymore.
Not anymore. You were.
I was. I will be watching it. I will be tuning in.
Okay.
But my fingers won't be on a keyboard.
Because you're busy later in the
typing.
day.
Yes.
Okay.
Coming back here.
That's awesome. I love
Exactly.
it. Hey, someone also who is going to be watching this very closely, I know, is Jason Britton. He's founder and CIO at Reflection Asset Management. He joins us for our Drive to the Close from Mount Pleasant, South Carolina. Jason, how are you?
I'm well, Tim. How are you?
We're doing well. You guys have about $6 billion under advisement, $200 million in two publicly traded funds with not an ESG focus, something that you like to call SEE. Why is ESG no longer the way to describe how you're thinking about this stuff?
Great question, and I get that all the time. I think predominantly ESG as a term has been weaponized by the right, and that there's been a lot of stories and a lot of uncovering research around the quality of that data, where that data is coming from, and frankly, how that data should be used. And from our clients' perspectives, that they're corporate decision-making tools. So we use SEE because it's an investor's perspective first.
Stakeholders, environment, ethos are the way you think about those things. So that's like a screen for you?
It's actually a series of screens. So its purpose is not that different than you've seen ESG be used before. The difference is that rather than being a business decision tool for companies to avoid ESG risks, ours is a process to uncover and label those companies so they can be aligned with investors' values.
What do we know so far about whether, looking at SEE contributes to positive returns? Because I know some complaints with some of those ESG funds, at least in the ETF space, was that they actually looked just like the S&P 500 and so performed, just like the benchmark. And there wasn't much outperformance there.
So that's a great point, Emily. ESG versus SEE is a tool in the toolkit to be used. Neither one of those two things used in isolation will make up for bad portfolio management. You still have to be thoughtful. You're using it as a tool to narrow a list. You still have to be responsive. You still want to pick companies that are going to do well going into a falling rate environment. Just because it does well in ESG or SEE metrics doesn't mean you want to own it in all cycles. You still have to be good at stock selection.
Mm-hmm. So we have the jobs report coming up tomorrow. We have a Fed meeting in 2 weeks, not one. I thought it was next week.
Time flies, though, when you're having fun, so it might feel like 1 week.
Right. What are you watching right now as the biggest risk in markets? Is it further economic weakening? Is it actually data that comes in too hot and prompts the Fed to maybe reverse these plans for a more dovish end of the year?
So that's a great question. I think that I would put them in the following order. What happens tonight with Broadcom will be a tremendous indication of how the market trades tomorrow up until that release. 8:31, I think, is the time that thing drops. And you'll be able to tell right away whether or not it's going to be a 25 basis point or 50 basis point reduction. My view is that a 25 basis point reduction is best case scenario. 50 basis points to me is scary because it'll mean that they're seeing something that the broader economy hasn't necessarily priced in yet. Mm-hmm. And it'll make me a little more nervous about getting a little bit closer to the potential for recession.
So Jason,
25 basis points. Sorry, Tim, go ahead.
I was going to say, what's the number that you see to know that it's going to be 25 basis points?
I think if we come in at or around where the non-farm payroll number is expected, we should be fine. It's going to be a really big surprise one way or the other, or specifically, to the downside, that's going to cause them to do that 50 basis point drop.
Right. Right now, we are, at least the Bloomberg economists are expecting an addition of 165, which would be an uptick from the 114 added.
What if we got an upside surprise, Jason?
So that's actually not something the market's pricing into the September cut. I think that if you saw an upside surprise, you might see a change in the beige book language as it relates to, but I still think you're going to get a 25 basis point cut. I think Chairman Powell's remarks and Jackson Hole made it that there's not wiggle room there. Like they're really something really dramatic would have to happen, and I just don't see it in the cards.
I want to zoom out a little bit because we had a very volatile August. We really had, I think, a moment in the beginning of August where people thought that the market had taken a turn and there was no going back. Stocks dropped and they were not going to rebound. And then we had a pretty significant rebound. Now that we're headed into September, I feel like, Tim, we've been asking people, what do you expect? Do you expect the seasonality to take over and see stocks drop in September? Or are you more optimistic? How are you feeling about the rest of the year in light of the fact that we did have, such a significant market move last month?
So I think we're going to continue to see the markets be very choppy between now and the end of the year, even in a lowering interest rate environment. Right now, everybody's trading on news, right? I mean, you saw it with just NVIDIA and investors overreacting earlier in the week to the DOJ subpoena. They had a great quarter. Numbers were good, guidance was good, and all of a sudden the stock fell off, a cliff. My opinion is that we should be really looking at, diversifying out of some of the Magnificent Seven because they've had such tremendous run up, and looking at some of the other sectors. Small cap did have a nice rotation trade there when the yen trade unwound. Consumer discretionary stocks, things that will typically do well in falling interest rates environments. It'd be something I'd look to rotate out of the concentration in the Big Seven and into from a diversification perspective.
Let's talk a little bit about what you said with regard to earnings and Broadcom coming a little later today. Why are you looking so closely at results from that company?
I just think that's the canary in the coal mine, and the marketplace got their number from NVIDIA. They reacted to it. I think you'll see significant reaction here as well.
How does a report one way or another change how you're positioning yourself?
So the reality is we try to convince clients that you shouldn't be trying to time the market. It shouldn't be earnings report to earnings report, despite how difficult it is to resist the temptation to try to trade some of these stocks. I mean, if you did a good job at timing NVIDIA, and just in the last 2 months alone, you could have captured some significant alpha by being in and out and riding the momentum trade. The reality is, for most high net worth clients and for most investors, thoughtful, broad-based, diversified portfolios, you're going to naturally be over-allocated to tech because of the size, which was back to Emily's point around most ESG or SEE products would look and feel a lot like the index. Well, those companies tend to score well in most models, and they tend to be big drivers of how the market both performs and also is reacted to. So I think Broadcom is going to do a nice job. I expect, at least the whisper is, that the quarter will be just fine. It's all really going to come down to how management handles the questions and what they're going to do in terms of guidance. Jason
Britton, founder and Chief Investment Officer at Reflection Asset Management, joining us from Mount Pleasant, South Carolina. Thanks so much, Jason. Certainly do appreciate your time, and we'll see you next time.
This is the Bloomberg Businessweek podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 2 to 5 p.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.